Hi, I'm Wayne Zell. I'm an estate planning and business planning attorney. I'm discussing the basics of business planning, and now I'd like to talk about non-compete agreements. First, there's the traditional non-compete, which says that whoever's entering into the agreement can't compete with the business of the company with which you have the covenant. It usually includes some form of geographic restriction. Let's say, within 5 miles of a principal office of the company, you will not engage in the same activity as the company. It might also include a time restriction, say during the time that you're employed by the company, and 1 year or 2 years after termination of employment is the duration. If geographic or time restrictions are too broad or too long, the restriction may be considered an unlawful restraint of trade. A variation of the traditional non-compete is where the covenant prohibits you from doing work for any customers of the company that you've worked on or that had contact with for some period of time after terminating employment or your relationship with the company. The covenant also could prohibit you from hiring or soliciting employees or consultants or even vendors of the company for some period of time after termination of your relationship with the company. The typical remedies for the company in pursuing you if you violate the covenant not to compete or not to solicit or not to hire is an injunction, meaning that they have to go to court and ask the court to stop you from engaging in the offending activity. This would prevent you, as the covenantor, from competing with the company. The company also could sue for damages, for costs, for attorney's fees, and for actual damages that they've incurred as a result of your taking away their clients. These covenants not to compete usually arise in the employment or consulting arrangement. Absent adequate consideration, the courts sometimes question the enforceability of these covenants. Let me give you an example. Let's say you go to work for a company and they ask you to sign a non-compete agreement. And the agreement is given to you in consideration for your being an employee of the company, meaning that they haven't paid you anything extra, and that as long as you want to continue working for the company, you have to abide by the non-compete. But the non-compete says after you terminate employment with the company, you're not going to engage in any of the activities that you're currently engaged in for some period of time, say a year or 2 years after leaving the company. Some courts would find that that type of a covenant not to compete is unenforceable against you because it unfairly restricts you from engaging in the very profession that you're engaging in with the company. Let me give you another example. Let's say a company gives you a stock option or ownership of stock in the company, such as stock appreciation rights or actual shares, in exchange for a non-compete. Those types of non-competes are likely to be upheld because you've gotten something of value, according to the courts, in exchange for the promise not to compete for some period of time after terminating employment. Buyers of businesses always want their sellers to enter into a non-compete covenant. These covenants would prohibit the seller from interfering with the business that the buyer just paid a lot of money to purchase. Usually non-competes are broader and more restrictive here when you're dealing with a merger or an acquisition or a sale of a business. And they're typically going to be upheld in almost every state because there is adequate consideration in the form of the sale of the stock or the sale of the business in exchange for the promise not to interfere with the buyer. If there's a higher purchase price, the covenant may be more restrictive. And if there is significant value to the non-compete covenant because the seller really could compete with the buyer after the sale of the business, the IRS may require that you allocate a portion of the purchase price as the buyer to the non-compete. If a portion of the purchase price is allocated to the non-compete covenant, a buyer can only deduct the non-compete over 15 years, and it's deducted by form of amortization, and it's treated similar to goodwill. On the other hand, a seller must recognize any payments received for the non-compete as ordinary income instead of capital gain, which usually arises on the sale of stock. So be careful when you're allocating a portion of the purchase price in an acquisition to a non-compete covenant. So those are some basics of non-compete agreements. Next, I'm going to talk about commercial leasing tips.